Look at this skyline. 40 cranes, 50, more than any city in North America. For a decade, Toronto told itself a story, that this was the most desirable city on the continent, that the towers would fill, that the money would never stop coming. And for a while, that story was true. Pre-construction condos sold like concert tickets. Investors lined up before sunrise. Developers couldn't pour concrete fast enough. Then the music stopped. Nearly 4,000 brand new condo units, finished, sitting empty, in one of the most densely packed real estate markets on Earth. That number is not a blip. It is up 131% from just 1 year earlier, and it is 5 times higher than it was in 2023. But here's the thing. Everyone is talking about the wrong problem. The media keeps asking, when will prices recover? When will buyers come back? Those are the wrong questions, because the real problem isn't demand. The real problem is a financial time bomb buried inside the walls of those empty towers, and it's already going off. For nearly a decade, money was cheap. The Bank of Canada kept interest rates near historic lows, and developers and investors alike treated Toronto real estate like a guaranteed ATM. The logic was simple, and for a long time correct. Buy a pre-construction condo today, rent it out when it's done in 3 years, and let rising prices and cheap debt do the rest. Investors flooded in. At the peak, over 60% of new condo units in the GTA were being bought not by people who planned to live in them, but by investors betting on perpetual appreciation. Then, in 2022, the Bank of Canada did something it hadn't done in a generation. It raised interest rates fast. And everything the condo machine was built on, cheap financing, rising rents, and unlimited demand, started to crack. Let's start with the numbers that should have made every headline. According to Urbanation, pre-construction condo sales in the Greater Toronto and Hamilton area plunged 64% year-over-year in 2024. Total sales for the year, 4,590 units. That is the lowest figure recorded since 1996. Not since the mid-90s, when Toronto's population was nearly 1 million people smaller, have so few condos changed hands. And Q4 2024, down 71% year-over-year. The market didn't slow down, it stalled. By Q2 2025, new condo sales had fallen to 91% below the 10-year quarterly average. Overall 2025 sales tracked as the lowest in 35 years. For context, that takes us back to 1990, the tail end of the last great Toronto real estate bust. Think of the condo market like a bathtub. New supply is the tap, sales are the drain. For years, the drain was fast enough. Now the tap is wide open and the drain is nearly shut, and the bathtub is overflowing. According to data, unsold inventory across all stages of development reached 24,045 units in Q2 2025. That's still historically elevated, at 7 times balanced market conditions. 7 times. Months of supply hit 6.72 months in March 2025. That's 89% above the prior year. A balanced market, for reference, sits between 2 and 4 months. We are nowhere near balanced. Now here is where this stops being a market story and becomes a human story. Because most of those unsold units aren't owned by faceless corporations. They're owned by regular investors, often middle-class Canadians who bet their savings on this market. And right now, those investors are hemorrhaging money. A landmark joint report by CIBC and Urbanation found that investors who closed on new GTA condos in 2023 were facing average negative cash flow of $597 per month, every single month. That's more than double the loss recorded just 1 year earlier in 2022. The maths are brutal. Ownership costs jumped 21% from roughly $2,687 to $3,250 a month, driven by higher mortgage rates and maintenance fees. Meanwhile, rents only rose 8% to around $2,700 a month. That $550 gap is the wound, and it's not closing. 77% of all investor-owned new completions in 2023 were cash flow negative, and for nearly a third of those investors, the monthly loss exceeded $1,000. When individual investors bleed, eventually they sell or they walk. When developers bleed, entire buildings die, and that's exactly what's happening. According to Urbanation, 21 condo projects totaling 4,412 units have been canceled since early 2024. A High Park church conversion project entered receivership in 2024 and was eventually sold off, leaving buyers in legal limbo. And then there is Sam Mizrahi, once one of Toronto's most celebrated luxury developers. His crown jewel, The One, a proposed 91-story super-tall designed to be Canada's tallest building, it entered receivership. So did his Yorkville project and his Vaughan project. The man who promised Toronto its tallest tower is now in financial ruin. His assets are being sold by court-appointed receivers. The buyers who believed in his vision are left holding contracts on buildings that may never be completed as designed. Sean Hildebrand, president of Urbanation, said it best. The market has entered a phase of the downturn that is really starting to wreak havoc. Project cancellations are mounting, construction starts are collapsing, jobs are being lost, buyers are losing a lot of money, and developers are facing difficulties with closings. Let's make this personal. If you bought a pre-construction condo in Toronto in 2021 or 2022, here is your reality today. Your unit finally closed. The key is in your hand, and your mortgage payment, condo fees, and property tax together total $3,250 a month. Your tenant is paying you $2,700. You are losing $550 every single month before you've paid for a single repair, a single vacancy, a single legal dispute. You have three choices: hold on and keep bleeding, sell and absorb a loss because resale prices have dropped significantly, or stop paying and let the bank sort it out. None of those options are good, and for tens of thousands of Canadian investors, that choice is happening right now. Resale condo sales dropped 19.3% year-over-year in January 2026, even as active listings climbed, which means more sellers, fewer buyers, and prices that have nowhere to go but down. So where does this end? The optimists will tell you that immigration is surging and rates will eventually fall. They are not wrong about the fundamentals, but fundamentals operate on decade-long timelines. Insolvency operates on 30-day intervals. The pipeline of new completions is still enormous. Tens of thousands of units sold during the boom years are still making their way through construction. As they close, each one forces an investor to decide whether they can hold. What we are likely to see is a sustained, grinding correction, a slow, painful deflation. More cancellations, more receiverships, more investors forced to sell below cost. The cranes are still up. The towers are still rising, and from a distance, Toronto still looks like a city of limitless ambition. But inside those gleaming towers, the financial reality is something else entirely. A market that told itself it was different, that the rules of economics didn't apply here, is now learning what happens when the gap between story and reality finally closes. Toronto built a city on the assumption that the money would never stop. Now that the money has stopped, the question isn't whether this market corrects, it already is. The question is how many people will be left holding the bill when the towers finally go quiet.